Welcome to the Daily Brief, where I'll go over the action in the market for Tuesday, February 14th, and then we'll see how things look for Wednesday, February 15th. We had kind of a mixed day. The market gyrated up, it gyrated down, and by the time everything got said and done, we were pretty much back where we started, so not a lot was really decided either to the upside or the downside. What I'm really seeing in our charts is we have some significant overhead resistance above where we're at. Unless we can break through and close above that level, the market's going to have a real hard time going higher. If we continue to go down, we do have support where we're at right now, but if we break that support, that's going to turn everything a lot more negative. In the meantime, we've been more or less chopping sideways and not really anything is getting decided. It was hoped with the CPI being released, which came out as expected but had some warning signs, that things would get solved, but they really didn't get solved in Tuesday's session. Let's go back and talk about what happened. Right at the open, we did have a lower open. Even though the CPI came out as expected, the market took a negative reaction to it, at least in the futures market. But when the market opened, prices opened right about near the daily pivot at 41.23. And then we saw some real buying entering in. There's still this buy the dip mentality that's going around, so that anytime the market shows some weakness, there's a lot of folks coming in and buying, thinking that this is a good opportunity. It's not a philosophy that I follow, but a lot of people do, because it can really burn you when you're wrong. So after we had the lower open, prices then shot up to R1 at 45.53. Then we fell all the way down to S1 at 41.07. We fell even below that. We retested 4100. As the day went on, we were able to rebound up off of 4100. This is when some of the buying the dip folks came in. But then we hit resistance at the unchanged level. After we hit that, we chopped above and below the unchanged line, only to close pretty much unchanged on the day. So we were down 0.03%. Volume was below average. That's another thing to be aware of. We were really anticipating the CPI coming out, and to have the market still trade after that and below average volume is a little bit concerning. It means that nothing has really been worked out yet. We have some other major economic reports coming out, including retail sales and PPI, and maybe that will help to define what the market wants to do. The technicals were kind of mixed right now. We're seeing some conflicting signals in our charts, not a lot of uniformity right now, and that has to do with inflation and interest rates. Of course, we have the geopolitical concerns, earnings as they're coming out, the debt ceiling issue, which has not been resolved yet, are just some of the areas that the market is really fixated on right now. Here's the intraday chart showing how we had almost a gap lower open right at the daily pivot, but then some buying came in, shot us above R1. That acted as resistance. Then we shot all the way down below the daily pivot, tried to rebound a little bit, but then eventually got down to S1, fell even below that. Here's the 4100 level. We set up a base there, and we're able to come back up only to hit resistance at the unchanged level. Then we went a little bit above, a little bit below, and then closed just about where we started. What are some comments that we can make? Growth did outperform value. In Monday's session, value outperformed growth, and that was a little concerning. The NASDAQ and the NASDAQ 100, they were up on the day, so that's more positive. On a short-term basis, the Sean trend meter as well as the stochastics are still giving us some extreme positive readings. We don't have anything that's oversold right now. The dollar was down and interest rates were up. We still have all of our yield curves that are inverted. Sentiment is still positive. We're just below that 75 level where we start to get extreme positive. We had been at 70 and it even ticked up, probably due to other indexes other than the S&P 500 that had gains on the day. I'll go over the CPI report on the next slide. Our trend is still positive and getting stronger. We're above the moving average and the ADX is going up. We're above 20. So that establishes a trend, but we're not seeing that really follow through into the price action. I've kept our bias at mixed because we had an up day on Monday, a slightly down day on Tuesday. Looking at the CPI report, it was up 0.5% on a month-over-month basis as expected. The last time we had this report, it was up 0.1%. The interesting thing about that is initially we were told it was down 0.1%. Then they revised it to up 0.1%. And that caused a little bit of concern in the markets. The core CPI, which is when you take out food and energy, it was up 0.4% month over month as expected. This was also revised up to 0.4%, where last time it had been up 0.3%. So the total CPI was up 6.4% on a year-over-year basis. And the area that's causing concern specifically with the Fed is the services area, or what they call services inflation. When you take out energy, it was up 7.2% on a year-over-year basis. Last time we had a pretty high reading as well at 7%, and this is what is causing a lot of concern. If you go to shadowstats.com, they have their own way of presenting the CPI information. The red or yellow line, which combines to make orange, that is the official number that we were told, and we were given the reading of 6.41%. Last time it came in at 6.45%. If you look at the blue line, this is how they calculated it back in 1990. We would be up at about 10% inflation. The next chart goes all the way back to 1980 and how it was calculated then. If we still calculated things the same way, we would be at 14.48%. The last time it was giving us a reading of 14.52% compared with the red line down here, which is the official number that they gave us. So if you look at it this way, inflation still is a lot higher than the official number that's coming out. This is the Inflation Now casting, which is put out by the Cleveland Federal Reserve, just showing on a day in and day out basis how is inflation looking. They're trying to predict what the CPI inflation will be, what the core inflation will be. That's the red and blue lines on top. And then the other report that gives us an inflation measure is the PCE report. The PCE inflation is the yellow line, with the green line being core PCE inflation. Our Ulcer Index is still showing that there's a lot of complacency in the market, not an awful lot of fear. The VIX came back down and closed below 20, also suggesting there's not a lot of fear in the market, both with the line chart and with the bar chart. Volatility of the VIX is starting to decrease. It looked like we were breaking out both on the bar chart and on the line chart. Well, now we're starting to come back down. So the VIX itself is starting to become a lot more tame. Of course, that could change at any time. Our trend shows the ADX still above the moving average. We're above 20. So we are in a trending environment, but we're just chopping sideways as far as price action is going. The green line's on top, so we still default to the positive trend. But if we can't break out of this sideways range that we've been in, that's going to have an impact on the overall trend. Our Arun, after giving us a real extreme positive reading with the oscillator, is still starting to come down as buyers are decreasing. Sellers increase just a little bit, but this is still positive overall, but coming off of an extreme positive reading. The daily chart is just showing how we have this R1 resistance level, which is also going back to previous highs, and we just have not been able to break above that. So far, we're still above the December highs. On a positive note, we still have a recent golden cross, and we're still above this trend line that the market bumped into a lot in 2022. At the bottom, volume really dropped below average. Here's a longer term look at that same chart, just showing the different support and resistance levels so I can show you more where they came from. The stochastics, the short term is not extreme and ticking down slightly. The intermediate short term is trying to turn back up, where the long short term is still looking pretty extreme positive. Our oscillators, we're still seeing more sideways action to slightly negative with the slope. We're turning down a bit with the TSI. The MACD is crossing over negative, but the PMO has not crossed over yet. The PPO has. It's looking a little more negative to sideways. And then our longer term oscillators are rolling over, but they haven't turned negative yet. Here's the PMO with some studies showing how the PMO is just barely above its moving average and getting kind of to an extreme level, where other times when we hit this level, that's when we saw a reversal. If you look inside the PMO, based on price and volume, we have already turned negative and dropped below the moving averages. Another look at the PMO shows that the PMOs that are rising are declining, but not giving us an extreme reading. We're pretty much sideways with the buy signals and flat to slightly higher with those PMOs that are above zero. Swindle Trading Oscillator, pretty much flat based on price and volume. We're below zero with both, so that has more of a negative context. The Sean trend meter, after giving us an extreme positive reading, came back down. Now it's going back up, but we're still in this extreme positive territory. The BPI, after giving an extreme reading, has now been coming back down, but really isn't moving all that much. As we've been going sideways, there's not a lot of new point and figure buy or sell signals inside of the S&P to generate anything new. Looking at the broad market, the NYSE bullish percent index, after breaking out above the summer highs, we topped out. We're starting to come back down, but we're still pretty much flat from Monday to Tuesday. Chaikin money flow still positive, ticked up slightly, so this is looking better overall. TTM squeeze, we still have blue bars, but they're dark, so that's more of a negative flare to the positive side. Then looking at the double and triple exponential moving averages, we're dealing with this anchored moving average going back to the all-time high. So far, this is held up as support, and we're getting a reading right now of about 40.86 to round it up from 40.85. If we start to go down, will this level hold, or are we going to break down through that? We're looking more positive with the triple above the double right now, and that's suggesting more of an uptrend. Our short-term fib level, we were able to get back above and stay above this 100% retracement level. That just means this area, which kind of goes back and forth, whether it's support or resistance, well, we were able to close just a little bit above that, even with the slight down day. Longer-term fib look from the all-time high going back to the October lows also suggests that this 50% retracement level at about 41.52 or 53 is offering some pretty significant overhead resistance. Then a longer-term chart shows that we're still in no man's land. We have more resistance above at 42.13. We also continue to have support at 40.20. Our moving average study showing a little bit of a tick down with the 20, 50, and slight decline with the 200. We're still above all the moving averages in the moving average tree, and the longer we can stay above that, the more positive it looks. We want to see if we continue to fall, are any of these moving averages going to act as support? The Elder Impulse system has switched back to neutral for the S&P. McClellan Oscillator has now dropped below zero, so that's slightly negative, where our summation index based on price is declining slightly. It was trying to turn up after Monday. Well, after Tuesday, it's turning back down, where it's looking more decidedly negative based on volume. So this chart is more negative overall. New highs, new lows, not really seeing much of a breakout either way, so our 5 period is going sideways, and we're sideways to slightly up with our 10-day moving average. Advanced decline line still is holding up. Based on price, we're still above this moving average, both based on price and volume, but we saw a bit of a tick down based on price where we were flat based on volume. Accumulation distribution, this is also still looking positive. Our volume indicator just shows how volume has really been dropping off. The black line is below the red line, and the histogram continues to decline. Our longer-term moving average study, we're still extreme positive with the 150 and 200 moving averages. The diamonds are still positive, even though they were down 0.41%. They have a green bar. The NASDAQ was up on the day. It was up 0.57%, but we're still seeing if we can get back above this R1 level. And the same thing is true with the NASDAQ 100. It was up 0.71%, looking a little more positive. The Qs are still neutral with blue bars. Praying bottom fishers trying to cross over. I don't know how much validity I would put into this. The best signals tend to be when we're way down here close to minus 30 and then we cross and start to come back up, where you can see other times we've done that. But a cross is a cross, so we still want to heed this. Looking at some of our possible positive scenarios, since growth was up, we're seeing a little bit of an advance with the Qs to the S&P 500. Discretionary to the S&P 500 turned up, and large cap growth outperformed large cap value. Just looking at growth and value, here's where the large caps continue to do better. We're seeing a little bit of improvement with the mid caps, but we're pretty flat to slightly positive with the small cap growth to value ratio. I wanted to bring this chart up just because we've been working off of this spike, which often provides some support for the S&P. It was coming back down. Well, now it's starting to go back up, and it may be getting ready to set an even higher spike. Also, the 10-day average of the highs minus the lows for the S&P, this is not moving. This indicator's been at about the same reading now for a couple of days. We're still extreme positive. That's the negative side, which means that we might be exhausted, and that's kind of being reflected in the market action. On the positive side, we were able to get up to this level with a good, healthy advance, but we're just kind of sitting at that level. So there's some positive and negative things you can take from this chart. Our 50-period exponential moving average of the highs and the lows still continue to be positive, and that's much longer term. And here's the indicator, which is the black line, and then the red line is the 50-period moving average. We're still looking viable with our staples to S&P 500 ratio where we spiked up and we're coming back down. It looks like we're setting up kind of a base here. We don't know if this is going to continue to fall or if this is going to come back up. As long as it doesn't exceed this spike, this could be a valid signal which gives support to the S&P. Our outlook for Wednesday, there are some more economic reports coming out this week that are really being looked forward to. We have the PPI coming out on Thursday. Our technicals are mixed right now. Do you want to look at the market as half empty or half full? You can make a case for either side. On Wednesday, we'll have the weekly MBA mortgage index, retail sales, which will be the big one, Empire State Manufacturing, which applies more to New York, industrial production and capacity utilization, business inventories, as well as the NAHB Housing Market Index. And then all the listed geopolitical events, keeping an eye on everything, but the markets are still really fixated on inflation and interest rates. Looking at the Stock Traders Almanac statistics for February 15th, we're pretty much across the board, neutrals to slightly positive with the Dow, S&P, and NASDAQ being up 66.7% of the time. We have a slight positive slant with these statistics. And then all the other things that I go through kind of periodically are adding more to what could be a positive backdrop. We had a scheduled speech on Tuesday from Michelle Bowman. Didn't really seem to impact the market. Then on Thursday at 4 p.m., we're going to have Governor Lisa Cook giving a speech. Our scenarios, hard to go with the down one right now because our technicals are mixed. Again, half full, half empty. Kind of hard to go with the up one, even though we have to default to that because the ADX is having the green line on top. And we can't go with the sideways because our ADX is getting stronger. It's above the moving average and we're above 20. So our conclusion, the S&P is mixed. How's that for decisive? Short term, we're positive, but showing some mixed signs as well as intermediate term. Long term, we're still above the 200-day simple moving average, and we had a recent golden cross. Thank you. I hope you found this helpful, and I will talk to you in the next video.